The month you retire can cost you more than $60,000. Not over your lifetime, not spread across decades of compounding losses. In year one, in the first 12 months after your last paycheck, and before you figured out what to do with your Tuesday afternoons, the federal government is already reading a photograph of your financial life from that year to set your Medicare premium 2 years from now based on income you will never earn again. That's not a metaphor yet. That's the mechanism. And once I show you exactly how it works and how directly it connects to which specific month you choose to stop working, you're going to look at your retirement date the way a photographer looks at lighting. Not as a finish line, as a composition decision. I've spent more than a decade surrounded by accountants and tax attorneys who can spend 3 hours debating whether to delay Social Security by 14 months, who obsess over the income stack, the bracket collision, the deferred compensation timing, the pension election options. And in all that time, I have never once, not a single time, had someone walk into a conversation and say they'd thought carefully about which month to retire. They say, probably spring. They say, when I hit 65. They think in seasons and milestone birthdays. The IRS thinks in 12-month calendar years. And the IRS does not celebrate birthdays. Let me fix that. What I'm going to walk you through today is a set of interlocking systems: federal income taxes, Social Security benefit, taxability, Medicare income surcharges, Roth conversion windows, and pension credit calendars that all read from the same single data point: your total income between January 1st and December 31st of the year you stop working. Every one of these systems is directly shaped by which month you retire, and none of them are typically presented together in a financial planning conversation. The combined cost of getting them wrong in year one is not a rounding error. It's a car. It's 2 years of travel. It's something real. By the way, I built a free early retirement calculator because most of the ones you find online are mathematically wrong. It uses BlackRock and Vanguard logic to identify the actual weak points in your plan, and I only ask for your email to send the report. I don't store any of your financial data. Link is in the description. Here's the frame I want you to hold for everything we covered today. I call it the December 31st photograph. Every year, on December 31st, the IRS takes one picture of your financial life. Everything that happened between January 1st and December 31st is in that photograph. Your wages, your pension starting date and first payments, your initial Social Security deposits, your IRA withdrawals, the PTO lump sum your employer cut on your last day, your final performance bonus, the dividend income from a taxable brokerage account that didn't pause for your retirement party. Every dollar that touched your financial life in that calendar year, all of it, in one frame, frozen. The month you retire determines exactly what ends up in that picture. Retire in December, and the photograph is packed wall to wall. Retire in February, and it is mostly empty space. Space you get to fill strategically, deliberately, with income you designed rather than income that happened to you. The photograph doesn't lie. That phrase is going to come back because every system I'm about to walk you through reads from that same frame. The federal tax brackets, the Social Security provisional income formula, the Medicare IRMA look back, the Roth conversion opportunity in year one, the pension credited service calendar. Every single one of them reads from the same photograph. You cannot change when it is taken, December 31st, every year, regardless of your plans or your feelings about the matter. What you can change is what you put in front of the camera before the shutter clicks. Before I get into mechanics, I want to establish the central reversal because most people are solving the wrong problem. When people worry about retirement timing, they worry about the market. They lie awake asking whether the S&P 500 is at a reasonable level, whether a correction is coming, whether they should wait 6 more months for the dust to settle. Sequence of returns risk is real. I'll come back to it. And it connects to the photograph in a way that almost nobody discusses. But the risk that actually dominates year one isn't what the market does in January. It's what your tax return looks like on April 15th. You think the market is the problem. The market is not the problem. The income stack is the problem. And here's what should make you pay attention. Unlike the market, The income stack is entirely within your control. You cannot call the index and instruct it to hold steady while you transition. You absolutely can decide whether your salary is still accumulating when December 31st arrives. The market is a variable you cannot influence. The photograph is a variable you can almost entirely design. In a normal working year, your tax return is one-dimensional. Salary, maybe some interest or dividends, done. In a clean, steady state retirement year, you control the income, how much to draw from the IRA, when to start Social Security, whether to do conversions. You have real leverage. But in the transition year, the year you actually retire, you are in a hybrid, a collision. Income sources that would never normally share the same tax return are suddenly jammed into the same photograph. Your salary from the months you worked, your pension starting up in that same calendar year, adding to the stack, your first Social Security checks if you begin right away, an IRA withdrawal to cover cash flow while everything settles, a stock award that was vesting on its own schedule regardless of your plans, the PTO lump sum your employer paid out on your final day. All of it lands on one return, one photograph, one shutter click. And the US federal tax system is progressive, which means the stacking is not linear. You don't pay 22% on all of it. You push into higher brackets only on the dollars at the very top of the stack. But those incremental dollars, the ones that tip you from the 12% bracket into the 22% bracket, they get hit hard. The result is that a lot of people retire expecting to drop into a lower tax bracket and instead accidentally create the highest income year of their entire retirement, not of their working life, of their retirement, which is the exact opposite of what every Roth conversion strategy, every Social Security optimization, every Medicare planning conversation assumes as its starting point. Let me make this concrete. Married couple. In steady state retirement, they have combined Social Security of $36,000 per year, a pension of $24,000, and IRA withdrawals of $30,000. Total gross income, $90,000. The standard deduction for married filing jointly in 2026 is around $30,000. Taxable income, $60,000. They're in the 12% bracket. Their accountant is unbothered. Their retirement is working as designed. Now run that same couple through their retirement year. They retired in October. One spouse worked 10 months. That's roughly $67,000 in additional wages on top of everything else. The retirement year photograph now contains $157,000 of gross income. After the standard deduction, taxable income is around $127,000. They are firmly in the 22% bracket, pushing the upper end toward 24 on the highest dollars. The federal taxes owed that year are not double. They are more than double the prior year. We are talking about a tax bill $15,000 to $20,000 higher for doing nothing wrong, making not a single financial mistake, for retiring in October instead of February. That is the bracket collision. It's happening silently while you're focused on your going away lunch and who's going to cover your clients. Now, there's a second mechanism inside that crowded photograph that almost nobody talks about, and it involves Social Security specifically. The IRS doesn't tax your Social Security benefit uniformly. There is a formula. Your adjusted gross income plus any tax-exempt interest plus 50% of your total Social Security benefit. The result is called provisional income. If your provisional income as a married couple is below $32,000, none of your Social Security is taxable. Zero. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, 85% of your Social Security benefit is subject to federal income tax. In steady state retirement, our couple's provisional income lands around $45,000. Some Social Security is taxed, but it's manageable. In the October retirement year, provisional income blows past $100,000 because the salary is in the photograph. 85% of every Social Security dollar is now taxable. That adds $3,000 to $4,000 of additional tax liability in a single year from the photograph being too crowded. They didn't make a bad investment decision. They retired in October. Retiring in February would have kept their salary contribution to the photograph at roughly $12,000. Provisional income stays low. Social Security taxability drops significantly. The bracket collision barely materializes. Here's what that conversation sounds like when people piece it together, usually about a year after they file the return. So you're telling me the month I retired is what caused this? Yes. That is exactly what I'm telling you. Not the investments, not the market, the calendar. In a few minutes, I'm going to walk you through a full side-by-side scenario, October versus January, with specific dollar amounts for one person. The difference will feel like reading a receipt for something you didn't order. But first, I need to talk about the mechanism I think is the most overlooked financial grenade in American retirement planning, because it doesn't blow up immediately. It blows up 2 years later. And it keeps billing you for income you will never earn again. It's called IRMA, Income-Related Monthly Adjustment Amount. The Medicare Income Surcharge. When you enroll in Medicare, which most people do at 65, your premium is not a flat rate. It is based on your income, but not your current income. It is based on your income from 2 years ago. The Social Security Administration looks at your IRS tax return from 2 years prior to determine your Medicare Part B and Part D premium for the current year, which means the December 31st photograph you created in the year you retired is the same photograph that sets your Medicare premium 2 years later. The photograph doesn't just affect your tax bill in the year you take it, it follows you. In 2026, if your modified adjusted gross income as a single filer exceeds $106,000, IRMA surcharges apply. For married couples filing jointly, the first IRMA threshold is approximately $212,000. The standard Part B premium in 2026 is around $185 per person per month. The first IRMA tier adds roughly $74 per person per month on top of that. One person, $888 extra per year. A couple, $1,776 extra annually for income they no longer earn. From a calendar year, they are no longer in. At the highest IRMA tier, the surcharge runs approximately $594 per person per month above the standard premium. Over $14,000 a year extra for a couple, for income from a single photograph taken in a year that is already history. The photograph keeps billing you long after the camera was put away. By the way, hit subscribe if you're finding this useful. YouTube's algorithm may genuinely never surface my videos to you again if you don't. And this gets more specific from here, not less. I want to tell you about Dave. I'll call him Dave because I've seen this story in enough variations that it has stopped feeling like a specific person and started feeling like a pattern. Dave retired at 64, planning to enroll in Medicare at 65. He retired in November because his project wrapped up and HR mentioned it would help the team transition more smoothly. Dave had been planning retirement for years. The specific month felt like a logistical detail, not a financial variable. Dave's salary was around $90,000. He worked 10 months that year. Roughly $75,000 in wages ended up in his retirement year photograph. He also started his pension, took an initial IRA withdrawal to cover December and January expenses, and received a project completion bonus on the way out. Retirement year gross income, around $130,000. He paid more in taxes than he expected. He figured it was a one-time overlap, a transition cost. 2 years later, Dave enrolls in Medicare. His Part B premium comes back higher than the people around him are paying. As a single filer, his retirement year modified adjusted gross income of $130,000 exceeded the $106,000 IRMA threshold. He pays nearly $1,800 more in Medicare premiums in year one than his neighbor who retired in March with functionally identical underlying retirement income, different retirement year photograph, different monthly bill. Then Dave's accountant explains the Roth conversion window that no longer exists for year one. Dave gets very quiet. Dave's story is not about bad investing. He made sensible decisions. He saved consistently. He did everything the general advice told him to do. He retired in November instead of February. And that specific calendar choice cost him a cumulative $40-some thousand in taxes, premiums, and foregone Roth conversion value over the first 5 years of retirement. The photograph doesn't lie. There is an appeal process for IRMA. Most people who get hit by it never know this exists. It is called a life-changing event appeal. Retirement qualifies as a life-changing event. The form is SSA, 644, available directly from the Social Security Administration's website. You file it, document the retirement, and Social Security recalculates your premium based on your current reduced income rather than the 2-year look back. The process works. It is not a long shot. It is an official mechanism that most affected retirees simply never learn about, and they pay the surcharges for a year or two before the look-back period naturally corrects. File the form. But not needing to file the form in the first place, because the photograph was clean, is always the better outcome. You don't want to be in IRMA's waiting room if you can help it. Now, I want to bring in the sequence of returns angle I mentioned earlier, because it connects to the photograph in a way that most retirement income discussions skip over entirely. Sequence of returns risk is the mathematical reality that the order in which you experience investment returns in the early years of retirement matters more than your average return over the full retirement period. If you retire into a down market and are forced to sell portfolio assets at depressed prices to fund living expenses, you permanently impair the recovery potential of your portfolio. The shares sold at a loss are gone. They cannot participate in the rebound. This is a real risk. It's why a flat 7% average over 30 years is not equivalent to a market that drops 30% in year one and then averages higher afterward. The connection to the photograph, retirees with a crowded retirement year photograph are statistically more likely to need larger IRA withdrawals in year one to cover an unexpected tax bill. That withdrawal happens regardless of what the market is doing. If the market is soft in year one, which is random, genuinely unpredictable, you are selling more shares at lower prices than you planned because the tax bill arrived and you didn't see it coming. The crowded photograph doesn't only damage you directly through taxes. It can amplify sequence of returns exposure by forcing unplanned portfolio liquidation at the worst possible time. January retirees with a cleaner photograph and a lower year one tax bill have more flexibility. They can use cash reserves to fund a tax-efficient year one and leave the portfolio untouched if the market is soft. That optionality is real. It's difficult to put a precise number on it because market conditions are unpredictable. But the direction of the effect is consistent. A cleaner photograph gives you more choices when the market decides to be uncooperative in year one. Now let me show you the full picture with one person, specific numbers all the way through. Maria, 58 years old, 30 years with the same employer, annual salary of $85,000, defined benefit pension of $30,000 per year. Beginning the month she retires. Traditional IRA balance of $450,000, planning to delay Social Security until 67 to maximize her monthly benefit. No significant taxable brokerage income. Maria is thinking about retiring in October. She wants to complete a major project, give her team a real transition window, and be finished before the holidays. Completely understandable. Emotionally, most people would make the same call. Here's what October costs Maria. 9 months of salary at roughly $7,083 per month. $63,750. Pension begins November 1st. 2 months of payments, $5,000. IRA withdrawal in December for upcoming cash flow needs. $15,000. Retirement year gross income, $83,750. After the approximately $29,000 standard deduction for a single filer in 2026, taxable income lands around $54,750. She's in the 22% bracket. Federal income tax owed approximately $8,500. Now January, Maria, she retires January 31st instead. 1 month of salary, $7,080. Pension begins February 1st, 11 months of payments, $27,500. Same $15,000 IRA withdrawal. Retirement year gross income, $49,580. After the standard deduction, taxable income is roughly $20,580. She is in the 12% bracket. Federal income tax owed, approximately $2,400. Federal tax difference between October Maria and January Maria in year one, approximately $6,100. From a date change, same employer, same pension, same IRA, same plan, different shutter click. Layer on, IRMAA. October, Maria's retirement year. Gross income is $83,750. The single filer IRMA threshold in 2026 sits around $106,000. She's technically under it by about $22,000. But that buffer disappears fast. A slightly larger IRA withdrawal, a capital gains distribution from a mutual fund, any unexpected income, and she crosses the line. 2 years later, a Medicare premium notice arrives that feels disconnected from the retirement year that caused it. In January, Maria's gross income of $49,580 puts her more than $56,000 below the IRMA cliff. She can take a larger withdrawal. She can absorb investment income. She can act without watching the threshold. And then the Roth window. January. Maria, in year one, has taxable income around $20,580. The ceiling of the 12% bracket for a single filer in 2026 is approximately $47,150. She has nearly $27,000 of Roth conversion space available at the 12% rate in year one alone. She converts it. She pays roughly $3,240 in federal taxes on that conversion. That $27,000, growing at 7% annually over 20 years, becomes approximately $104,000 tax-free. No required minimum distributions. No income tax for her heirs. No future bracket pressure from that money. October, Maria is in the 22% bracket in year one. Converting those same $27,000 costs $5,940 in federal taxes, 83% more than January. Maria paid for the same move. She waits for year two, but in year two, her pension has been running for 12 full months, dividend income may have grown, and she is 1 calendar year closer to required minimum distributions beginning at 73. The cleanest year of her Roth window was year one. The crowded October photograph closed it before she even knew the window was open. Estimated 10-year cumulative difference between October Maria and January Maria, $40,000 to $55,000. Same investments, same salary, same retirement plan. One photograph, different month. Now, let me add something that almost nobody thinks to look for, and it lives on page 217 of plan documents that nobody reads. Some defined benefit pension plans calculate benefits using credited years of service, and some of those plans operate on a strict calendar year basis. The rule typically reads, an employee is credited with a full year of service for any calendar year in which they complete at least 1 hour of work. 1 hour. Work on January 2nd, you receive credit for a full year. Retire November 30th, you miss the credit year entirely because you didn't complete a single hour in the following January. Here's the math. 1 additional year of credited service in a defined benefit pension typically adds between 1% and 3% of your final average salary to your annual benefit. On a pension paying $60,000 annually, 1 additional year of credit adds $600 to $1,800 per year. Over 25 years of retirement, $15,000 to $45,000 of total additional lifetime income. From working 2 days in January instead of stopping in late November. Dave missed this. He retired November 30th. The pension credit calendar reset January 1st. His HR department didn't mention it. The summary plan description covered it on page 217. Nobody reads page 217. His accountant only discovered it when reviewing the pension election paperwork 18 months after the fact. This is not a guarantee in every pension plan. Structures vary enormously. But the point is consistent. The month you retire interacts with systems you don't know exist until after the decision is made. The pension credit rule is one of those systems. The IRMA look back is another. The Roth conversion window is another. The bracket collision is another. The December 31st photograph touches all of them simultaneously, in the same frame, at the same moment. So you're telling me the month I retired is what did this? Yes, that's what I'm telling you. Not the investments, not the market, the calendar. There's something else nobody puts in the spreadsheet. I want to name it directly because I think it's real and it affects the quality of the transition itself. Those final months, October, November, December, when you already know you're leaving, are some of the most peculiar and draining months of a career. Not because the work gets harder, because the investment in outcomes is gone. You're attending project meetings for deliverables you'll never see completed. You're mentoring someone into your role while running on institutional muscle memory. You're present in the physical sense. Mentally, you already left. That is a specific kind of exhaustion. It's not physical tiredness. It's the fatigue of performing engagement you no longer feel. And people don't put it into the retirement timing calculation because it's not a line item. But here's what it costs when you do factor it in. If retiring in January or February is worth $45,000 over 5 years and costs you zero financially, and it saves you 3 or 4 months of sitting in buildings you're emotionally done with, then staying through December for the team handoff is one of the most expensive professional courtesies you will ever perform. You arrive at the starting line of retirement already carrying a particular fatigue, the clarity and energy of a clean January start that's not just psychological. It affects decision-making in year one, when the most important financial decisions of your retirement are waiting to be made. A person who starts retirement fresh in January or February with a clean photograph and low income is in a radically better position to think clearly about Roth conversions, Social Security timing, and asset allocation than someone who arrives exhausted from a December exit, bracing for a tax bill they didn't anticipate. The photograph doesn't care about your feelings, but your decisions do. Here's a way a lot of these conversations go. Have you thought about the optimal month to retire? I was thinking maybe spring. And what does that mean for your provisional income? My provisional what? Great, spring it is. Now, let me give you the framework I use to organize all of this. I call it the 3 levels of retirement timing damage. Level 1 is the bracket collision. Your salary and your retirement income overlap in the same photograph. You pay more in federal taxes that year than you ever needed to. This hits almost everyone who retires after June, and it intensifies every month deeper into the calendar year you go. It is the most visible, the most immediate, and the one that shows up when you file your retirement year taxes with a vague but specific feeling of having been charged for something you didn't order. You did everything right. The calendar did the damage. Level 2 is the IRMA delay. Your crowded retirement year photograph triggers Medicare surcharges 2 years later for income you no longer earn, from a year you no longer think of as exceptional. The bill arrives with a 2-year fuse. Most people pay it for a full year or more before anyone explains that the SSA 44 appeal form exists and fixes it. File the form if you're hit, but the deeper planning lesson is that avoiding the crowded photograph in the first place eliminates the problem before it starts. Level 3 is the Roth conversion window collapse. This level doesn't arrive as a bill. It arrives as an absence. A strategy that was never deployed. A tax-free balance that was never seeded because year one was too crowded to plant anything. The cost is entirely in what didn't happen in the compounding that was never initiated. A person who misses 2 or 3 years of 12% Roth conversions because their photograph was too full in year one is looking at a growing traditional IRA that will eventually be subject to required minimum distributions at whatever tax rates exist in the future, withdrawn by heirs under the 10-year depletion rule. The level 3 damage grows silently, and it compounds against you every year it goes unaddressed. You can get hit at 1 level, 2, or all 3 simultaneously. If all 3 land, the cumulative cost over the first decade of retirement reaches $50,000 to $60,000 of entirely avoidable taxes and premiums. Not from bad investing, not from a market downturn, from one calendar decision often made based on a project deadline and what HR found convenient. Dave figured all of this out in year 3. Not year 1, not year 2. Year 3, when his accountant sat down with him and worked backward through the IRMA notice, the missed Roth window, the bracket collision, and the pension credit that didn't accumulate. Dave looked at the total and said, this was all avoidable. His accountant said, yes. Dave was quiet for a while. Then he said, so the whole thing came down to what month I retired. That's the whole thing. Dave is fine. He retired comfortably and he'll remain fine. But Dave carries a particular and permanent knowledge that a different month would have been worth approximately $45,000 in cumulative costs and foregone opportunities. That's not a dramatic number against a full retirement portfolio. It's also not nothing. It's a car. It's 2 years of travel. It's a meaningful contribution to a grandchild's tuition. It's real money that existed in a parallel version of his retirement that was only one calendar decision away. And what drove the decision? A project deadline. And what HR thought would make the team transition smoother. The photograph doesn't lie. It just bills. The boring choice. Yeah. Retire in January and miss the December party? Long pause. You're going to miss $60,000. Another long pause. Here are 3 things to actually do with this. 1, before you set your retirement date, run a retirement year gross income estimate for 2 scenarios: the month you're currently planning and January or February of the same year or the year following. Add your salary from the months you'd still be working, your pension income for the months it would run, any IRA withdrawals you'd need for cash flow, and whether Social Security starts that year. Total it, subtract your standard deduction, find your federal bracket, then calculate your provisional income adjusted gross income plus 50% of any Social Security benefit and compare it to the taxability thresholds. Then look at your modified adjusted gross income and compare it to the IRMA thresholds of $106,000 for a single filer and $212,000 for married couples in 2026. That single 2-scenario calculation will give you more useful intelligence about your retirement year than any market forecast you've ever read. 2, know the SSA 4-4 form exists before you need it. Pull your last 2 years of tax returns and locate your modified adjusted gross income. If your retirement year photograph is going to push you over the IRMA threshold because of salary overlap or an unavoidable PTO payout or a final bonus, prepare the SSA 4-4 form before you even enroll in Medicare. You can file it proactively with documentation of your retirement as the qualifying life-changing event. You do not have to wait for the premium notice to arrive and then scramble. The Social Security Administration processes these appeals. They work. Most people who qualify for the appeal simply never learned it existed. 3, map your Roth conversion window before you choose a retirement month, not after. Identify when your pension reaches its full annual run rate. Identify when you plan to start Social Security. Identify when required minimum distributions begin at 73. The span between your retirement date and the earliest of those 3 events is your window. Year 1 of that window, the 12 months immediately after your last paycheck, is the cleanest, lowest income, most strategically flexible year of your entire retirement. Do not let a crowded December 31st photograph eliminate it before you even knew it was available. If you must retire later in the year for reasons that are genuinely non-negotiable, at minimum, make that a deliberate decision with full awareness of what year 1 costs you, not an accidental one made around project timelines and seasonal convenience. Lazy investing built more fortune than crypto memes, and retiring the right month built more wealth than most people's entire market timing strategy combined. The photograph doesn't care about your feelings. It doesn't care about the project. It doesn't care that HR wanted a smooth handoff. It records what was there on December 31st, and then the IRS, Medicare, and the Social Security Administration all read from it for the next 2 years, billing you accordingly. Control the photograph. Everything else follows from that. The boring move is almost always the right move. Go be